All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. We just had the Fed Beige Book come out, and it's an interesting one, and let's go through it. But market's down just a little bit here. The article that was up here isn't up here anymore, so I won't go to it. But there are some spots out there on the web that you can go to and find the market blogs and the blogosphere type stuff. And it's some of the bears really out and growling and claiming some victory here today with what is a 13, 14 point drop in the S&P, 12 point drop as it sits right now. That tells you how dominant the bullish market has been when the bears are going to declare victory or get all excited over a 12-point drop. It's that type of market. But we're kind of back towards Monday's lows, essentially, kind of having rehashed those a little bit this morning. And small caps lagging, like we talked about earlier today. But the Fed Beige Book. And this is a report that the Fed comes out with monthly here, and they talk about the economic conditions. And it's something that I think is important to kind of just understand, what they're saying. And so I'll read a few excerpts from it here. But basically, economic activity continued to expand in late January and February. Okay, so, we're sitting here at March 6th, and they're talking about late January and February. So it's fairly recent data. Okay, with 10 districts reporting slight to moderate growth, and Philly and St. Louis reporting flat economic conditions. About half the districts noted that the government shutdown had led to slower activity in some sectors, including retail, auto sales, tourism, real estate, restaurants, manufacturing, staffing. Consumer spending activity was mixed across the whole country, with contacts from several districts attributing lower retail and auto sales to harsh winter weather and to higher cost of credit. Manufacturing activity strengthened on balance. Interesting statement, but numerous manufacturing contracts conveyed concern about weakening global demand, high cost due to tariffs, and ongoing trade policy uncertainty. Activity in the non-financial services sector increased to a moderate pace in most districts, driven in part by growth in the professional, scientific, and technical services subsector. Residential construction activity was steady or slightly higher across most of the U.S., and residential home sales were generally lower. One of the things that it's highlighting is what we've seen from the economic data. The economic data is still showing growth. There are some pieces that are starting to show contraction, but it is very slight growth. The growth is slowing, right? The growth is slowing. And basically, if you graph it and you put it on a graph here, right, and you basically put, growth over time, right, growth and time, and, you have this kind of nice growth here going on. And sometimes that curve steepens and you get higher growth. But one of the things that's happening right now is the curve is getting shallower. So, yes, it's still growing, but that rate of growth is nowhere near what it had been. That's all the Fed's saying. That's all they're saying. That's all the Beige Book has to say. And no matter what area they're talking about, whether it be employment, whether it be manufacturing, whether it be services, whatever they're talking about, this is what they're saying. They are saying that the slope is getting flatter. So there's still growth, but it's slight. And there are risks that growth can go into contraction, and there's a possibility that growth can go into expansion. That's basically what it boils down to here with the Fed. Is the market reacting a heck of a whole lot? we talked earlier, the market typically doesn't have a huge reaction to the Fed Beige Book. I mentioned today it could have a little bit of one just because, it's a little bit market looking for something. But you can see the volume here on the Beige Book release. Barely any volume. 2-point move in S&P futures. So no, market is not reacting to the Fed Beige Book here at all. Okay, and one of the big reasons, there's nothing new in it. There's just absolutely nothing new in it. When you look at it, when you take it, for what it is, they're basically just saying what the market already knows and has already concluded. Right, has already concluded. So no real new data there. Nothing really to, nothing really even to break down or to say, well, there's a risk here or there's a positive or negative here or there. It's the same thing. And the same thing we've been talking about with the data here for some time. Okay. Now, market, as we talked about a little earlier this morning, market's a little bit different today, right? We talked about it this morning, about 2 hours after the market opened. Lo and behold, the market's at the exact same spot that it was when I was on video last time. Right, and yes, it dipped a little bit lower. It's rallied back up a little bit. Not a whole lot of volume associated with the move here this afternoon. And if I back this out to 15 minutes, you can see that it's just come down to Monday's lows. Now that's the S&P. Small caps, they blew through Monday's lows this morning. Right, they just absolutely plowed through them. Said bye bye. See you later. So, it's not like we can say everything's holding those lows, but the Dow's holding those lows. The Qs are holding those lows. In fact, the Qs have outperformed. And I think if you're bullish, this is one of the areas that you look at and say, hey, you know what? As long as tech outperforms, market tends to hold up. Forget about transports. Forget about small caps. Forget about all those other things that everybody else talks about. Tech has been the driver for the last 5 years. Hey, if tech holds up, market's going to hold up. And I think it's a very valid argument, right? But one of the problems with the argument is when you look across tech, it's very diverse. This is Micron. Not exactly holding up, right? Here's Apple. Okay, holding up a little bit, right? Here's Adobe. Okay, right back to the lows from Monday. Here's Google, right? Here's Google. Outperforming tremendously, not even close to Monday's lows, right? So, you have a very mixed bag here within tech, but the strength has definitely been stronger than the weakness when it comes to the tech group and to what is going on out there and with Facebook and Netflix. I mean, we talked about Netflix yesterday with them being able to shrug off, the investor getting on CNBC and talking about, establishing a big short position. Now, I've been watching, Netflix. I'd love to short it, but just haven't had an opportunity here just yet, any kind of signal here just yet to really sink my teeth into with it. Okay. As far as the market vibe goes, it's still neutral. It's not turning bearish today. It's a 5, but it is still a neutral reading. The bleed down in the market vibe has been a slow bleed, and it's the type of bleed reminiscent of a market going into consolidation, not a market that is being controlled by the bears. And that is something that could change. That is something that could switch at any moment. But where it sits, where it is right here, right now, that's where it is. Now, for the challenge, I've been all cash. I've talked about some of the stuff that I'm looking at that I'd like to get into. Unfortunately, Hal has dipped another 30 cents instead of rallied another 30 cents. I'm not going to chase Hal down here. Right? I will, if Hal is at 29 at the close, I won't get back in. I will wait for a rebound. I am not chasing Hal this far from the 7, and that does mean I could miss a move to 26. Right, that's what it does. I am not willing to be a chaser in this environment. If the market vibe were bearish, I'd be a little more apt to want to chase, but I am not willing to chase in this environment, and on a stock that the CCI on the hourly, has come down to this kind of minus 250 oversold area. It's just not willing to chase, and ultimately, that could mean that I miss out, but at this point, I still look at the 2970 to 2990 area as my kind of re-entry area, the area where I could look to get back in when it comes to Hal. I've looked at FedEx. I think I'm going to scratch FedEx off my list to trade if I have another position. If I don't have another position on the board, okay, I'll put a little into FedEx short-term options, right? But I can't get anything too longer term here when it comes to FedEx. UPS is a way I could play it. The options are better, and so I could go and play that with UPS and play that downside, which I do like a lot when it comes to UPS, and at least for it to come back into the 107, 106 and a half area. My question is my risk reward good enough? And that's what that's kind of where I look at UPS. I say, well, it's good enough if I have a really tight stop area, but I would have to use a very tight stop area, and there's just not a good one. They're arbitrary. The stop areas are pretty arbitrary. I'd probably just have to play this like I played JP Morgan, where if it gapped above the 7, I got to get out, right? And, if you remember from last week, and I'm sure you do, JP Morgan, I went and shorted it right here, right? And, when it gapped above the 7, I had to go. Yes, it reversed and snapped back and reversed, and, it's pretty much where I got in it at. But, a gap above the 7, the probabilities of moving on higher are just too great for a short-term option. So, if I were to go after a UPS, that's kind of what I would have to do. And the whipsaw risk would be high, right? A gap up tomorrow would mean I take a loss, move on, done. And do I really want to get in that kind of position with some of the other things kind of starting to form out there? Yeah, not really. Not really. When it just, when it absolutely comes down to it, some things like Ford, GM, interesting looks to the downside and some very interesting hourly charts here to go with some of the daily charts, here in them. These are not on my challenge watch list, and, I won't trade those for the challenge here just yet. But and many of you know why. But overall, bearish action for sure. We're seeing some bleed action in some of these, like a FCX and an Alcoa, just in that bleed mode here with them. I did price out some Alcoa options, but you take a look at here, ARNC. Let's see if I can type it right. Arconic, not exactly breaking down while Alcoa is. You look at something like a BHP or a Rio, and we talked about the tops being in on these, right? And, this type of reversal day, high volume reversal day, tops are generally in. But we did go and look at what Micron looked like when it put its top, and some of the rebound back, some of the rally back that it had. Yes, it did ultimately put a short-term top in and everything, but I have to look. Now that Rio's rallied on back, look at that and go, okay, this is getting really interesting, when it comes down to it. And if you look at, the put options here on Rio, the spreads are sizable, right? They're not tiny. So this is, this is one where, I can't just get in and have a tight stop level or something of that nature. I'm going to have to, get into it and have a little bit of conviction here with it. But you look at the April options, and for $1.80 I get a 37-cent delta. I mean, that's pathetic. That's absolutely pathetic. And so, a $2 move lower, by the time time decay kicks in, I make 30% on my option. I mean, that just, no thanks, right? And that's not a product of the option being overvalued. That's not a product of something being wrong here. That's just a product of the time, right? That's just a product of the time. And we're in a funky time. So it's one where I want to kind of stick with some things that have weekly options so that I can get the time that I want without, having to overpay. And, there's plenty of stuff like that out there. But nothing kind of, nothing I'm too eager to pull the trigger on right here at this exact moment. But I'll do my my typical research and scanning and watch list looking here as we go into the close. I would like to go into the close with a position. I don't really want to go into the close with cash, but we'll see kind of where things set up. But that's the Fed Beige Book. That's what's going on with the market vibe here today. And with a few other things out there. I was asked about trend rider signals coming in today, so let me just pull them up. I don't have the real scan on this computer, but this one, it just shows the number of stocks piercing the lower Bollinger Band. Sorry, that's the upper Bollinger Band. Here we go. Piercing the lower Bollinger Band today. There are 44 of them. Here's a bunch of them. Now, most of these will not qualify as trend rider bears, but there's a lot of stocks piercing that lower band. If we come back and we sort this, now let me go back here and sort this. And we'll just do S&P 500. You can see we have, 7 stocks? And they're all kind of in that same area. Citrix, Lam Research, Micron, Maxim. I mean, these are all semiconductors, right? These are all semiconductors. We have a truck and 2 medical supply companies. So we're not seeing mass, type of trend rider breakdowns going on out there. I mean, here's CHRW. I mentioned I was looking at some CSX earlier today, but, have not gotten the cue to, to go after that here just yet where it sits. Thanks for hopping on. Have yourselves a great one. I'll put my my final thoughts into the into the feed here in about 40-45 minutes, and we'll talk to you later. Take care.